Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Kevin Davitt, Head of Index Options Content at Nasdaq, as well as Mike Khouw, CNBC contributor and YieldMax strategist at YieldMax ETFs. We're here to discuss what investors need to know about quadruple witching options expiration, continued growth of retail participation, and trends to watch for 2026. It's great to see the both of you. As always, welcome back to Trade Talks. And Kevin, before we get into the year end, the last quad witch for 2025, I want to discuss another key end of year event. Last week, Nasdaq's index group announced the details for the annual Nasdaq 100 reconstitution. What do investors need to know about this process?
Yeah, that is a good question. And like you said, it was announced a week ago, last Friday after the close, and it will become effective when markets open this coming Monday on the 22nd. From the perspective of how does it matter to an investor, understanding that the Nasdaq 100 is a systematic rules-based methodology, I think is important. I think one of the reasons that these annual reconstitutions are broadly important and that passive index investing has tended to do so well is that the process is one whereby underperformers are cut and the index adds winners every year. That's effectively what's going on under the hood. And I think many investors get psychologically tied to losers and they aren't great at letting winners run. So more specifically, this year, 6 companies were added across technology names, industrials, and healthcare. 6 names were deleted. There's an average market cap of right around 50 billion entering the index. And there's a very similar volatility profile within the names and the makeup that are being added to those that were deleted. From my perspective, I think this is just further evidence of the Nasdaq 100 becoming like the preeminent large cap growth index. And it's the type of exposure that many people are looking for. Now, underneath the hood, index funds will rebalance. And it's estimated that something right along the lines of 50 billion in equity trading will be done today to replicate the new index. Now, the last thing I'd do is point out that Nasdaq's chief economist, Phil McIntosh, put out a great piece that outlines the importance of this process. If you're interested in more of the details, you could go to his author page on Nasdaq, and there's a great bit of information there.
Yeah. Mike, let's talk about the significance of the December 2025 quadruple witching options expiration. Does it make for good headlines, quad witch, or does it truly impact volatility, volumes, liquidity?
I mean, it's a great name. It should happen near Halloween, I think. That would probably be when everybody would get excited. Look, we get quad witching 4 times a year, and there are some things you will see. You'll see higher volumes on any expiration day when contracts are rolling off. Almost mechanically, you're going to see higher volumes because you're going to see people rolling positions. And of course, if you have more contracts expiring, which you will on a quad witching day, then you are going to see higher volumes. But I think the name would be potentially scary to investors. It shouldn't be. If you take a look at the quad witching that we've had so far this year, and you looked 30 days in advance, right? Because, this is behind us essentially at this point. So the real question for investors is, what are the implications as we look forward? The first one crossed over the tariff tantrum, if we're going to call it that post-Liberation Day sell-off. So, the quad witch took place at the end of March. And then, of course, if you look 30 days ahead, you would say, wow, things were a lot lower. But that was really related to those events, because if you then look forward to the next quad witching, which took place at the end of June, the market was substantially higher, and the last one in September, we're basically at a push. So I don't think people should focus too much on whether that's going to have implications for investments necessarily, but they should expect to see much higher than average volumes on those days.
Yeah. And Kevin, continuing on this theme of, the market moving higher over the year. I mean, it had a rocky start to the beginning of the year, but it ended up being another strong performance for U.S. equities, large cap growth in particular. What's the bigger narrative, and how's the setup going into 2026?
Yeah, I think Mike did a good job of explaining it from a sort of quarter to quarter basis. And it was a rocky start. It seems like a long time ago. I suppose what I would do is point out that the Nasdaq 100 is outperforming other major equity benchmarks again. I'd like to put a couple numbers around that for the listener. So if we focus on year to date, the Nasdaq 100 is outpacing the S&Ps by about 400 basis points. That kind of seems like it's becoming par for the course. But if you stretch that out and you think about the implications or the bigger picture, this is likely, assuming nothing very unusual happens in the last week of the year, this is likely to be the 14th year in the past 18 where the Nasdaq outpaced the S&Ps. That's where it becomes, I think, really impactful for investors. And we talk about the power of compounding generally. The older I get, the more I appreciate Einstein's take on how it was something like the eighth wonder of the world. So let's make that a little bit more concrete. In a visual, I looked back to the beginning of like 2013, and I assumed a $10,000 one-time investment in a handful of index proxies, Nasdaq 100, S&Ps, and Russell 1000 growth. You can see visually how those performed through time. And as of yesterday, that NASDAQ 100 investment is worth more than $108,000. It's outpacing the S&Ps by more than 40 grand. And keep in mind that that's on a $10,000 one-time investment. So the takeaway there is that there's been tremendous compounding value and wealth created with assets tethered to the NASDAQ 100 index. And I appreciate and I love being able to support the growth of an increasingly influential and increasingly global index.
Yeah. And Mike, another key trend for 2025, we could even say this has been building on the trend, is the growth in retail participation, particularly with funds incorporating overlay or income strategies, leveraging option strategies, hence the name YieldMax. So you're a perfect example for this. What do you think is driving the demand for these types of strategies?
Well, I think, for one thing, they're relatively new. You know, we got that new rule interpretation from the SEC that went into effect in 2021, 18F-4, which was basically an assessment of how they were going to look at how derivatives are used in exchange-traded products. And, you know, that it did curtail some of the sort of more frothy stuff that was going on ahead of time. There was just a reach for ever higher degrees of leverage, I think, in some of those products. But now people are beginning to recognize that they can be used for income. And I think that that's probably something that a lot of investors are really interested in because, you know, once upon a time, people would invest in stocks because they paid nice dividends and they would rely on those dividends. That's less the case today. You know, it's really interesting what Kevin was talking about. There's two dynamics just about the index construction for the NASDAQ itself that I think are kind of important. For one thing, we have begun to use it as our principal benchmark for performance in the funds that we manage. That was always traditionally going to be something like the S&P historically. And the reason is because those, you know, the NASDAQ actually composes all of the important companies really that matter in, you know, when it comes to growth. So I think that's kind of an important element to all of this. And, you know, I mean, we've also seen just an increase in the use of options, listed options generally. I mean, the compound annual growth rate for options volumes is considerably higher than it has been for equity volumes. And I think these two things, you know, relate to one another.
And Kevin, despite the 20+% return for the NASDAQ 100 this year, it's been a pretty bumpy ride. What kind of volatility metrics stand out to you, and how could that have implications for those thinking about risk management in the coming year or so?
I think there's a great tie-in here with the point Mike just made about equity volumes relative to option volumes, and hopefully I can make that point. I mean, you're absolutely right that it hasn't been a linear ride, and effectively it never is, but it is easy to forget how many challenges there have been kind of along the way. Now, with respect to the sort of look back on volatility, we do have a visual, and the thing that stands out to me is that we've seen this year a higher average volatility. We have seen higher low marks for volatility and higher highs when we're pointing to a VXN measure, which uses NASDAQ 100 index options to have a constant 30-day forward expected volatility measure. So keep in mind, these are option-based metrics that increasingly play a role in how end users are managing their exposure. If we looked at the realized volatility story, it's a very similar one. Realized volatility in the Nasdaq 100 looks like it's going to work out to right around 23.5% this year. Now, giving that a little context, that compares to just over 18% for the previous 2 years. So markedly higher realized volatility this year. If I were forced to look out to next year, I personally wouldn't be surprised to see realized volatility again in this 20 to 25% range. I would point to there has been tremendous earnings growth this year. One of the points Mike brought in as far as the Nasdaq 100 has all the names that people are really looking for. That's led to a market where we've seen essentially no PE expansion. We'll see if that continues in 2026. And I think my outlook is for continued growth in tools like index options and in equity options, because so many people are now understanding how powerful they can be. And on the index side, so many appreciate that cash settled nature. And come a couple of months from now in tax time, many will appreciate the potential tax benefits there. I appreciate the opportunity to highlight this stuff, Jill.
All right, you got it, Kevin and Mike. To wrap up here, what are future trends that you expect for 2026 for the market overall?
Well, I think one of the things we're certainly going to see is more of what we were just talking about, which is I expect in 2026 that equity options and index options volume growth is going to outpace equity volume growth over that period. I don't see any reason for us to believe that the trade that we're ending on, the hot trade for 2025, is not going to be the lead story in early 2026 as well. I will say that, I remember the late 90s and I remember the early aughts. One of the dynamics that we saw, one of the things that Kevin is highlighting now, was that, we saw some increases in volatility in the late stages of that rally. This is a very different one in the sense that the companies that he was just highlighting indeed have seen legitimate earnings growth, and multiple expansion hasn't really been the story the way it was then. But if you do start to see earnings growth slow and you start to see increases in volatility as well, then you're probably going to want to start thinking about using some of the index protection that he was just talking about. I personally think that the cash settled products are probably the best way to do that, because you just don't have any assignment risk issues. And as he pointed out, you get that mixed straddle 60-40 tax treatment, which can really be advantageous for a lot of investors as well.
All right. Appreciate both of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.